Hi, welcome to this edition of New Knowledge. I'm pleased to welcome our speaker today and everyone in attendance. Rusty Little is Director of Finance for the Wellspring Foundation of Southwest Virginia. He serves there where he oversees financial strategy, budgeting, and physical operations to support the foundation's mission-driven initiatives. He has an extensive experience in financial management, and he plays a key role in ensuring the foundation's resources are effectively stewarded to serve the communities of Washington, Grayson, Smith, and Russell counties. He brings a strong background in financial analysis, compliance, and strategic planning, helping to guide Wellspring's efforts in accomplishing its mission, and his leadership has been instrumental in implementing sound financial policies and maintaining transparency in the foundation's operations. And he's here today to talk to us about financial projections. And because many startups fail due to poor financial planning, so this presentation will help you avoid that. So please welcome Rusty Little.
Thank you, Mark. It's a pleasure to be here, and thank everybody for joining. We'll get started. Financial projections are really the cornerstone of any new business strategy. You've got to put a lot of thought and thinking into this whole process. They can be used not only to attract potential investors by showcasing anticipated profitability, but they also serve as a roadmap for the owner for strategic planning and resource allocation. If you're securing a loan for your business, banks will typically require financial projections as part of that loan process. By forecasting future financial needs, businesses can proactively address challenges before they arise. Central to these projections are the three key financial statements: the income statement, which reveals profitability over time; the balance sheet, which offers a snapshot at a point in time of the company's financial position; and the cash flow statement. This details the movement of cash in and out of the business. Being able to understand and master these documents is essential for steering your startup towards success. The revenue projections lay the foundation for assessing business viability. Projecting revenue is both an art and a science. You begin by analyzing your market size and identifying your target audience. You study the industry trends to understand typical growth rates. For instance, a lot of startups forecast significant growth in their early years, with an average of about 268% in the first year, 144% in the second, and 71% in the third. Your pricing strategy and chosen sales channels will heavily influence these projections. It's crucial to base your forecast on key assumptions, such as your expected market penetration rate, cost of acquiring new customers, and the average value of each transaction. And these factors combined will provide a realistic estimate of your potential revenue. Now, I meant to say at the beginning, if anyone has any questions as we go through, you're welcome to ask as we go along or at the end. So cost and expense projections. Understanding your cost is vital for accurate financial projections. Fixed costs, such as rent, utilities, salaries, will remain constant regardless of your business activity. Variable costs fluctuate with production levels and include expenses like raw materials and shipping. Operating expenses encompass the day-to-day cost of running your business, including marketing efforts and administrative functions. Salaries and wages can account for up to 50% of a startup's expenses, so it's really critical to accurately project what those expenses are going to be. A comprehensive grasp of these expenses can help ensure that you manage your budget effectively and maintain financial health. Profit and loss projections. These help startups determine when they will become profitable. This projection combines revenue projections and cost expense projections. When we analyze these revenue streams against operational costs, businesses can estimate what their financial trajectory is. When are they going to hit the break-even point? When will they hit profitability? So key profitability indicators such as earnings before income taxes, depreciation and amortization, and net profit give insight into a company's startup's financial health, while projected margins indicate long-term sustainability. Investors closely examine these projections to assess a startup's potential for success, as well as banks when they're considering providing a loan for that business. Break-even analysis is determining the startup's profitability. It helps startups determine when they will start making a profit. Break-even point is a level where your revenues and total cost equal, meaning there is no profit or loss. Understanding the balance between the fixed and variable cost is really critical in this calculation. Break-even formula provides a clear way to assess how many units a business needs to sell to cover their cost and become profitable. Cash flow projections, which in my opinion is probably one of the most important financial statements. It's crucial for startups to maintain that liquidity and avoid any financial shortfalls. Tracking your cash inflows from sales, investments, and loans helps businesses anticipate and budget for available funds, while monitoring outflows such as operating expenses and debt payments ensures sustainability. Startups really have to focus on liquidity management to avoid running out of cash. And this is really a common reason for early stage failures in new businesses. Looking at financial ratios and key performance indicators provide critical insights into a startup's financial health. Liquidity ratios, such as the current and quick ratios, measure a company's ability to meet short-term obligations. What you're looking at is, will my current assets cover my current liabilities or what I owe within a year's time? Profitability ratios like return on investment and net profit margin assess the earnings efficiency. Risk factors and sensitivity analysis help startups anticipate financial challenges before they arise. Market risks, such as economic downturns or increased competition, can impact revenue streams. Financial risks, including interest rate fluctuation, funding challenges, these all can disrupt cash flow stability. By conducting scenario planning, evaluating financial projections under best case and worst case conditions, startups can help prepare strategies to mitigate these risks and ensure long-term viability. So when you're actually doing projections, once you set your benchmark, your base case, look at a 10 to 20% variability up and down on your projections and look at what that does to your cash flow, your earnings over that same period of time. Effective financial projections are really vital for startup success. They provide a roadmap for growth and securing investor confidence, as well as helping you secure loans for your business. Strong financial planning helps guide decision-making, ensuring sustainable operations. Using data-driven assumptions for revenue and cost estimates allows businesses to make realistic forecasts. And additionally, continuous monitoring and adjustments to projections enable startups to navigate market fluctuations and mitigate those risks. So once you set up your projections, it's a really good idea to look at these monthly, look at how your actual results or comparing two-year projections. If you're coming in ahead of those projections, monitor it for a period of months and then adjust your projections accordingly. Same if you're coming in short on. So projections are critical. They provide for informed decision-making. They help business owners and stakeholders evaluate the feasibility, set realistic goals, and plan resource allocation effectively. They provide the roadmap for the expected revenue, expenses, and profitability. It helps attract investors and secure funding. Investors, banks, lenders require financial projections to assess the viability and risk of a business or product. Well-structured projections demonstrate financial discipline and increase credibility. Cash flow management and sustainability. A business can be profitable, but still run out of cash due to poor planning or timing issues. Accurate projections help ensure that the company can cover their operational cost, manage their working capital, and avoid liquidity crisis. Budgeting and resource allocation help in setting budgets for marketing, production, hiring, and other operational needs. They ensure that the spending aligns with the expected revenue growth. Identifying the risks and planning contingencies. These projections help identify potential shortfalls and allow businesses to develop contingency plans. Scenario analysis, which is the best case, worst case, and expected case projections. These help businesses prepare for any uncertainties within the market. Performance monitoring and strategic adjustments. These financial projections serve as a benchmark for measuring actual performance. Periodically comparing these projections to actual results enables businesses to adjust their strategy, cut costs, or scale their operations effectively. Pricing and profitability analysis helps determine break-even points, pricing strategies, and what the expected rate of return on the investment is going to be. It ensures that the pricing decisions support the profitability goals. Regulatory and tax compliance. The projections assist with tax planning, ensuring that the business is prepared to meet all of its tax obligations. It helps businesses meet regulatory requirements for financial reporting and investor disclosures.
Excuse me, Rusty.
Yes.
We had one comment because the last slide that's on the screen is your conclusion slide. Were there so somebody asked if there were supposed to be more slides, if the screen was supposed to be changing.
No, those were just notes that I'd taken throughout it, Jean, but I'll be glad to provide that.
Okay, thank you.
But that was just sort of my recap and conclusion.
Gotcha.
And I'll be glad to answer any questions anyone has. I will say you don't need a really sophisticated software to do projections. You can, when I first started at the foundation, all I've been using is spreadsheets for my projections and my budgets, and they work extremely well. But again, I think the critical piece is to continuously monitor what your projections are based on your actual results. That'll give you all the data that you need to adjust those accordingly.
Do you by chance have spreadsheets available where, like, if you put in your cash flow projections, that it will feed into the other spreadsheets?
I can build that for you. And really where you want to start is with the balance sheet as a new business. Assume you put $5,000 into your business. That's go hit your balance sheet. It's actually go hit the balance sheet and the cash flow statement. it'll show up as a asset, the $5,000 in your cash, and then your owner's equity. This is what you've contributed. This is capital that you've contributed towards your business. And then it'll flow over to the cash flow statement as contributed capital from the owner. But I can build something that will flow from one statement to the other. Now, the income statement is more of a standalone. That's strictly your income and expense items.
Okay, thank you very much.
Yeah. And I can get that to, I guess, Jean and let her distribute it.
Yeah, that would be good because we're gonna this session's gonna be recorded, so I'll be sending it'll be uploaded to our YouTube channel hopefully later today, if not tomorrow, and I'll be sending everybody the link to that as well as your PowerPoint and any other documents you want to send me.
Okay.
Thank you.
Yeah. I know that was short and sweet. I just didn't know how far to go into this, but like I say, I'll work up the Excel spreadsheet and send that on to Jean as well.
So Rusty, I think what they're asking about is all of these are different businesses that are in the business plan challenge. One's a food service. One of the folks here is a food service. One's retail and a interior design service. And so they're just trying to get an idea of what a statement of cash flow looks like and how it fits into their statement of financial position. And
so, yeah, each one of
there's-
these, they're separate components of the financial statements. The balance sheet, income statement, and cash flow are three separate. They are interrelated, but typically these are all going to be required for any type of projection analysis.
right.
You
And
go
so
to-
if you had something that was blank where maybe some of the lines didn't pertain to them, but they could figure out what does and what doesn't pertain, that
Yep.
would probably be really helpful for them because they're right in the middle of writing their business plan.
Yeah, I can get that to Jean by the end of the day.
Okay.
I can probably take some of mine that I've developed here and just clear them out and let them use them.
We're trying to get started and trying to figure out where to start. Right now, we're working on a brick and mortar location from a food truck, and we're planning to run both. But trying to figure out how to determine what profits and what expected income I guess there should be, because even running the food truck, we're not running it every day. We focused on getting started, learning the ropes last year, and specialized in events. Well, we grew our catering side of that, which didn't have to be an event, and now we're looking at running that plus a brick and mortar that has retail. And I feel like right now all I've really done is just hemorrhaged money. I mean, everything's paid. We're very fortunate for that. And we had a class last night. We're talking about credit and building credit, and I kind of felt, I guess, personally defeated because my grandparents had really instilled pay for it or don't get it, don't finance it, and all that stuff. And they've just really wrecked where I'm at right now because, okay, we have everything. We've got assets. Everything's paid for, but we don't have capital to work with. And trying to figure out how to get going with that. And we're going through a lot of changes right now. So where to start has kind of been the most intimidating thing for me personally.
So how long have you been in operation?
We started in October of 23. So we've got a year under our belts with the trailer, and we're just now facing brick and mortar.
So if I understand you correctly, the food truck is owned outright?
Yes.
That?
Yes.
The brick and mortar, are you renting that or are you?
It's leased.
Okay. When did you start your lease on that?
We just got keys this last week. We haven't announced that to anybody. So we're in the process of going through inspections and cleaning and just starting. We hadn't opened yet.
That wasn't included in your 1 year of operations?
No.
Okay.
No.
So a great starting point is that first year of operations. Do you have your balance sheet and income statement?
We're trying to plug numbers right now. To have, I'm going to say 15 events that we did for the year. I cannot believe how many receipts there are to sit and figure, because we've had propane and oil and food and admission and advertising and a bunch of different things that I'm having to plug in. And that was another class that I sat through and took a lot away from, because we were the shoebox people, I guess, where it's just bank receipts. So now I'm going through the organization and writing numbers and trying to figure that out. So that's where I'm starting. I guess I should say I have a start, but I need to be plugging numbers, and that's what I'm working toward.
Or are you doing this manually, or are you doing it in the spreadsheet? How are you?
Right now, I have the receipts, and we're doing it to paper. And
Okay.
everybody's had a different program that they've said to use depending on what they were familiar with.
Sure.
And I'm not. I mean, I'm tech savvy, but I'm not.
Yeah. Are you familiar with spreadsheets at all, or?
I am with spreadsheets somewhat. Yes, sir.
So that's really a good way to start from the beginning, because you can set up each column as a month.
Okay.
You can enter your income, your expenses, build some basic formulas to come up to your net profit. Once you get it all on paper, you can use the spreadsheet that I'm going to send out today to build on that.
Okay.
So Rusty, could you talk about what's a expense, and even though you spent the money, what you have to depreciate as an asset?
Sure. IRS regs, typically, the way I look at it, if the useful life of that asset, say the food truck, if you bought a refrigerator for the food truck and it cost $1,000, to me, that is a capital expenditure, because the life or the usefulness of that refrigerator is going to last more than 1 year. It typically may be a 5-year life. So you would depreciate that, which means you would take 1/5 of the cost of that refrigerator as an expense each year over that 5 years. So $1,000 refrigerator, you'd expense $200 a year until there was no value left, no monetary value left in that refrigerator.
So it would originally, Kenny, go on your balance sheet
It would go on your balance sheet as an asset.
for the full $1,000.
Yep.
And he's saying that he's estimated that it's got a 5-year useful life. And so, you would, now that food truck's going to be a different animal. Whatever you paid for it, it'll go on your balance sheet
That is
as an asset.
big
And I'd
stuff.
say it's probably got what would you think, Rusty, 10 or 20-year useful life?
Well, you got to look at the IRS regs. I mean, it gets a little more complicated, Kathy.
Okay.
There's generally accepted accounting principles, which you can use a different useful life versus what the IRS does. But for a small business like this, it's probably better to use what the IRS guidelines are.
Yeah.
That way you don't have timing differences, deferred costs, deferred. I mean, it's a little more complicated than.
It would probably be worth, if you're, this is your first year of business, it'd probably be worth paying a CPA to set all that up.
Okay.
That, they're expensive, but they set you up right, and then you don't have to worry about it again.
Right. Okay.
Because you've kind of got a unique situation. Rent's 100% written off.
Yes.
Food truck is not.
As you pay it, it's expensed. Yeah.
Right. And then your gas
Is expensed as you pay it.
is expense. Can you expense what it cost you, Rusty, or do you have to use that? Again, I don't know. Probably IRS guidelines, which a CPA would tell you, but sometimes there's certain rules that say, point whatever the mileage is.
Yeah, so standard mileage I wouldn't recommend for the food truck. You'd want the direct expenses, which would be the gas that you put in it, the maintenance cost that you put into it, I mean, those are your direct expenses to operating that food truck.
Right.
So yeah, the food truck itself is a fixed asset. If it costs you $20,000, that's going to show up as a fixed asset on your balance sheet. And then you'll expense a portion of that truck each year over that useful life. Gene just sent out a document that I believe it was for the useful life of assets. But like I say, it's probably better to follow the IRS guidance on useful life for fixed assets and depreciation.
Okay.
Gene noted in the chat that there's some IRS regulations for business expenses and a tax guide for small businesses online. So may be able to Google that and get some guidance as well. But
Well, and I'll get Gene a link to the IRS. I think it's Form 4596.
And I hate to interject. This is April Collins. I'm the director of the SBDC in Galax, Virginia. Our state, Virginia SBDC, is actually partnering with the IRS, and we are hosting an 8-week seminar from the IRS for small businesses. And so we just had our first one at the end of January, and we've got another one coming up on the 20th of February. And so we have the stakeholder liaison at our Richmond office for the IRS, Cheryl Jackson, and she's doing presentations every month for the next year for us. So if you're interested, there's a whole list of different courses and topics she's covering. I can put the link in the chat.
That'd be great.
Okay.
all right, again, thank you, Rusty Little with the Wellmont Foundation, or Wellspring Foundation. They're doing great work down there for the whole community. So thank you all very much. And we will get this posted and get those forms out to folks that are interested. And if you have any other questions, certainly contact us here at the Small Business Incubator at Virginia Highlands Small Business Incubator. And we appreciate our co-sponsor of this event, the Washington County Chamber of Commerce, and we have Nita Farmer with us today as well. So thanks, everybody. And if there's nothing else, have a good day.
All right, thank you.
I just wanted to mention again that on February 19th, our next New Knowledge, Justin Lewis, that taught last night's business challenge, is going to come back for a New Knowledge on February 19th, building credit and managing cash flow. So I think he's going to be going over a lot of that stuff that he talked about last night, but maybe more in depth. And if you still have questions, that's a perfect opportunity for you to ask him.
Good
Thank
deal.
you.
All right. Thank you so much. Thanks for joining us, everybody.
Thank you.
Thank you.